What if I told you it's possible to legally pay $0 in taxes through real estate? It may sound too good to be true, but it's not. In fact, real estate investors have been using tax strategies for decades to minimize, or even eliminate, their tax liabilities. The best part? It's completely legal, as long as you know the right tactics and follow the rules. In this video, I'll walk you through the strategies that top investors use to pay little to no taxes, share real examples from my own experience, and show you how you can start using these techniques to build wealth while keeping more of your profits. If you want to learn how to navigate the world of real estate taxes like a pro, make sure to like this video, subscribe to the channel, and hit the bell so you never miss a crucial strategy. 1. Understanding the power of depreciation. One of the most powerful tools available to real estate investors is depreciation. Depreciation allows you to write off the gradual decline in value of a property over time, which in turn reduces your taxable income. For residential properties, the IRS allows you to depreciate the property over 5 years, and for commercial properties, it's 39 years. In practice, this means you can deduct a portion of your property's value every year, even if it's appreciating. For example, if you purchase a rental property for $300,000, you can deduct a portion of the value, minus the land value, each year. This can significantly reduce your taxable income. I've personally used depreciation to offset thousands of dollars in rental income, lowering my tax bill to nearly zero in certain years. 2. The 1031 exchange. Deferring taxes by reinvesting. A 1031 exchange is another powerful strategy that allows you to defer paying capital gains taxes on an investment property when it's sold, as long as the proceeds are reinvested into another property of equal or greater value. This strategy is a great way to build wealth without having to pay taxes on the gains you've made. For instance, I sold a small rental property I had owned for several years, and instead of cashing out, I used a 1031 exchange to purchase a larger, more profitable property. By doing this, I was able to defer paying taxes on the $100,000 profit I made from the sale. As long as you follow the rules and reinvest, you can continue deferring those taxes indefinitely. 3. Real estate professional status. Tax deductions for full-time investors. Another strategy for reducing your tax bill is becoming a real estate professional, according to the IRS. If you qualify, you can deduct losses from your real estate investments against other income, like your salary. To qualify, you need to meet two key requirements. You must spend at least 750 hours a year working on real estate activities, and those activities must make up more than half of your total work time. I personally know several investors who've used this strategy to offset income from other sources, like their day jobs. For example, one investor I worked with qualified as a real estate professional and was able to deduct $40,000 in losses from his real estate holdings, reducing his taxable income to $0. Becoming a real estate professional can be a game changer for tax savings, but it requires time and effort. 4. Cost segregation. Accelerating depreciation. Cost segregation is a strategy where you break down the components of a property, such as the building, land improvements, and personal property, and depreciate them at an accelerated rate. This allows you to take larger depreciation deductions in the early years of ownership, significantly reducing your taxable income up front. For example, I used cost segregation on a commercial property I purchased, and by separating out things like lighting fixtures, carpeting, and landscaping, I was able to depreciate a significant portion of the property in the first 5 years, rather than spreading it out over 27.5 years. This resulted in a huge tax savings in the early years of ownership, essentially wiping out my taxable income from the property. 5. Tax-deferred rental income through the self-directed IRA. If you're looking to grow your retirement funds through real estate, you can use a self-directed IRA, individual retirement account, to buy properties. A self-directed IRA allows you to invest in real estate and other alternative assets, and the best part is that the income from those properties grows tax-deferred, or even tax-free. If you use a Roth IRA, I've personally used a self-directed IRA to purchase rental properties. The rental income generated by these properties goes directly into the IRA and grows without being taxed. This strategy allows you to defer taxes on your rental income until you withdraw the funds in retirement, and if you use a Roth IRA, those withdrawals can be tax-free. 6. The power of tax-free gains. Renting out your primary residence. Many people don't realize that you can sell your primary residence and exclude up to $250,000, $500,000 for married couples, capital gains from your taxable income. As long as you've lived in the home for at least 2 of the last 5 years. This is known as the primary residence exclusion. I took advantage of this strategy when I sold my first home. Because I had lived there for more than 2 years, I was able to exclude the $200,000 in capital gains from my taxable income. This saved me a significant amount of taxes and allowed me to reinvest those funds into my rental portfolio. If you own a home and are thinking about selling, make sure to take full advantage of this tax break. 7. Using real estate debt to your advantage. Real estate debt, such as mortgages or loans used to acquire or improve properties, can be used to your advantage when it comes to taxes. Mortgage interest on investment properties is tax deductible, which can further reduce your taxable income. For example, when I took out a mortgage to purchase a rental property, the interest I paid on that loan was deducted from my rental income. This helped lower my taxable income, and in some cases, made it possible to report a loss on the property, even though the property itself was appreciating in value. This is another great way to legally reduce your tax burden while building your real estate portfolio. 8. Bonus depreciation. Writing off 100% of certain property costs. Bonus depreciation allows you to deduct 100% of the cost of certain property assets, such as appliances, furniture, and certain land improvements, in the year they are placed in service. This is a huge benefit for real estate investors looking to quickly write off a large portion of their property costs. I used bonus depreciation on a multifamily property I purchased, and I was able to deduct the full cost of the appliances, HVAC systems, and other personal property right away. This gave me an immediate tax break, which helped offset the income from the property and minimize my tax liability in the first year. 9. Utilizing LLCs and S corporations for tax benefits. Many real estate investors create LLCs or S corporations to hold their properties and take advantage of certain tax benefits. These entities allow you to deduct business expenses, protect your personal assets, and potentially reduce self-employment taxes. I created an LLC to hold my rental properties, which helped me separate my personal finances from my business dealings. The LLC structure also gave me the ability to deduct expenses related to property management, repairs, and even home office costs. For more advanced tax strategies, it's worth consulting with a tax professional who can help you decide if an LLC or S Corp is right for your business. 10. The takeaway. Tax strategies you can use now. Legally paying $0 in taxes for real estate is possible, but it requires knowledge, strategy, and the right tools. By taking advantage of strategies like depreciation, 1031 exchanges, cost segregation, and more, you can build wealth and reduce your tax liability simultaneously. But it's essential to stay compliant with IRS rules and consult with a tax advisor to ensure you're using these strategies correctly. In my experience, the more I learned about tax strategies in real estate, the more I realized just how much I could save while still building my portfolio. It's not about avoiding taxes. It's about legally minimizing them to maximize your profits. If you want to pay less in taxes and build your real estate portfolio, these strategies are a great place to start. If this video helped you, hit the like button, subscribe to the channel, and turn on notifications so you never miss a tax-saving tip. Got any questions or real estate tax strategies of your own? Drop them in the comments. I'd love to hear how you're using real estate to legally reduce your taxes. If you are serious about building income streams like we do in real estate, then Tube Mastery and Monetization is what we personally recommend. Link is in the description.